It's been 3 years since the Great Recession ended, yet the recovery has been anything but robust. The economy seems to be stuck in purgatory, somewhere between recession and healthy growth. This rut is despite the government's stimulus program and the Federal Reserve's efforts to keep interest rates at zero and lower the cost of loans and mortgages. As global growth slows and a series of tax hikes and spending cuts loom, the risk for falling growth grows greater. If a recession does take hold, it could be devastating for the U.S. So what's the outlook for the U.S. economy next year? Joining me now is Jeffrey Cleveland, senior economist at Payden Rygel. Jeffrey, welcome to the program.
Thank you for having me.
So a lot of people think that this fiscal cliff is already weighing on the economy. What's your sense?
We agree. It is. We like to look at measures of economic policy uncertainty. And if you look at an index of this sort of thing, it is at record levels over the past 25 years. And so, this sort of gauges or measures the difficulty that businesses are having in terms of investment decisions and hiring activity. And we think it's costing the U.S. economy somewhere between 1 and 2 million jobs. So 2 million fewer jobs than we otherwise would have if there was more certainty on the policy front. I think it's having an impact already on the U.S. economy. See it reflected in CapEx.
Right, let's come back to CapEx in a moment because you said it's already affecting the economy. We know if we fall off the cliff, we go back into recession. But let's just say that a deal does get done in the 11th hour. We don't know what the deal is going to look like, but it could very well involve some spending cuts, some tax hikes. Do you still see somewhat of a drag on growth at that point, to the point where it could tip the economy back into recession?
I don't worry about the economy tipping back into recession. And that comes from our way of looking at the economy, which I think is different. I think the dominant view is to look at spending as the economy, right? And if you add up all the spending in the economy and you subtract, 200 billion or 400 billion, whatever your gauge of the fiscal cliff is, and you just subtract that out and hold everything else constant. It's a very mechanical way of looking at the world. We don't think the world is mechanical in this way. So we're actually optimistic because we do see some signs that the economy is actually on the mend. Nobody told the consumer that the fiscal cliff was coming, because it looks from auto sales, from hiring activity. There's lots of things that are sort of popping up organically that are good signs, and we expect that to continue even when the clock turns to zeros, or the new year begins, let's say, on 12/31.
I'm glad you brought the consumer confidence up, because, as you said, if we look at consumer confidence, it's at, a 4-year high. But on the flip side, you look at business confidence, and it's sagging because of this looming fiscal cliff. And you also have companies that are lowering their profit and sales outlooks. I mean, what does that spell for the economy next year?
It's just complicated. There's so much going on here. The consumer is on better footing. If we look at U.S. consumer, if we look at debt levels for the households as a share of GDP, or if we look at debt to disposable income, on both of those metrics, the consumer has delevered. And it looks like a much improved picture versus, say, 2006. So the consumer balance sheet is getting better. The death of the U.S. consumer has been greatly exaggerated. There's more than 2 million people employed this year compared to a year ago. So there's a lot to be optimistic from. I think you're seeing that reflected in things like consumer confidence. It also helps that the stock market is up, that house prices are up, even in places like Southern California. That's helping consumer confidence. Businesses are much more attuned to what's going on in Washington. So our large corporate clients follow every headline. So they're very focused on that, very, very centered on the fiscal cliff and the dysfunction, really, that they see coming out of Washington. So I think that weighs more heavily on them and maybe less heavily on the consumer. What
kind of GDP growth are we looking at next year?
If you look at the U.S. economy over the past, 70 years, it's amazingly resilient. It sort of grows at about 3%. We think we'll get back to that. The question is when. So this is not a permanent situation. The so-called new normal is not a permanent slower growth situation, but I think it's a situation that will persist until we get to about 2014 and into 2015 in our estimation. So I think for next year, we stay closer to 2%.
Was QE3 a good idea or a bad idea?
Here's our view. A central bank has a duty to be a lender of last resort. So in a crisis, in a liquidity panic, they have to use their balance sheet. In the modern era, they have to step in and become the interbank market, which is what the Fed did with QE1. What they've morphed into and focused on with QE2 and now QE3, this is more what I would call macro stabilization. And quite frankly, I think we expect too much out of them. It's too much to expect the central bank to be able to smooth out all of the business cycle. And the purchases of treasuries and agency MBS, for me, that's just taking what are pretty highly sought after liquid securities out of the financial system. I don't think it helps boost the economy. We don't think it's going to have an impact on the unemployment rate. So a long way of answering your question. QE3, not a good idea in our view.
Jeffrey, the unemployment rate is currently at 7.7%. That's down from 7.9%, but only because there's been a decline in the labor participation rate. Where do you see the unemployment rate at the end of next year?
We think that the payroll growth will continue at a moderate rate. The 12-month average on payrolls is about 150,000. The average for actually calendar year 2011 was also 150,000. So we think we're right in that 150,000 jobs per month gain. The problem with that is it's not a rapid enough gain to really bring the unemployment rate down. So I can't tell you with any confidence that the unemployment rate will be much lower than 7.5%. If we talk next time this year.
Is the labor market situation cyclical or structural in your view?
We think it is structural. And I know this goes counter to Mr. Bernanke and to most of the Federal Reserve Open Market Committee members, but we don't think it's cyclical. We think it's structural. We think, if you think of it, there's some sectors, we like to call it goods and government, that have declined since the start of the recession, and we don't think are coming back, at least not in a robust fashion.
So then what's the new normal in terms of the unemployment rate?
The new normal, the unemployment rate is probably going to stay higher than we would want for longer. And I think the way to look at this is the Fed is not going to be able to bring that unemployment rate down by trying to boost aggregate demand, keeping interest rates low, buying bonds. Because it's structural, because there's some structural impediments, that's going to keep it from coming down quickly. Now, that said, I know we're not in the camp that it has to hang out forever at 7.5%. The U.S. economy, as I said, is very resilient. I think we will head back toward 5%, 5.5% on the unemployment rate. It's again, that time horizon. It's going to take more time, and it's not going to be aided by monetary policy. It's going to require new businesses and new sectors and a retooling of the workforce in order to make that adjustment happen.
I want to get your outlook for housing because housing has shown signs of improvement this year. Prices have been rising after falling for 6 years. Inventory is less than a 6-month supply, which is considered a normal amount of inventory on the market. That's not to say there aren't problems, right? Credit still remains tight. We still need to see more traditional home buyers versus investors who are buying foreclosures to turn them into rentals. But what's your outlook for whether the housing recovery will continue next year?
I think modest improvement. I mean, the thing about housing is, if you look at housing starts, for instance, they were down 80% from the peak. So at some point, you expect a little bit of a bounce back up. And so I think we're seeing that. I think the bottom is here. We're still a little skeptical because we're sort of in the epicenter here in Southern California. If I look out east from my office, there's a lot of inventory that's still out there in the marketplace. So I don't think housing is going to come storming back as a meaningful contributor to GDP growth. I just don't think it's going to be a drag. And I do think prices are probably bottoming in here, and that over the next couple of years, they will continue to rise, and we'll see improvement. But it's not going to be back to the boom phase of, say, 2004 to 2006. And you highlighted the key reason for that. It's the credit mechanism. That credit mechanism has been shut off.
Jeffrey, thanks so much for your insight. Happy holidays. I hope to see you soon.
Take care.